Charles Stanley Direct. Investing made easy, cost-effective and flexible. Using our website or app. With our comprehensive range of investments, trade-in shares, funds, investment trusts and ETFs, there's a range to suit all levels of investor. Choose your own or consider our ready-made solutions. Simply sign up, choose from a range of accounts, ISA, Junior ISA, Investment Account and SIP. You can also choose from our range of socially responsible funds and get going from as little as £50 a month. Top up or withdraw anytime. Having been around since 1792, you're in safe hands. With our first-class help desk ready to assist, take control and invest with confidence today with Charles Stanley Direct. Sign up now.
Hello and welcome to Breakfast with Questor. I'm Richard Evans and I edit the column. With me today are two other regular writers, Dan Grote and Russ Mould. I'll introduce them in a moment, but first of all I'll briefly tell you what we hope to offer you in Breakfast with Questor. Most of the event will be given over to your questions, but before that I'll introduce the team and we'll each briefly give you a sense of how we come up with our tips, because the three of us work in different ways. We see this as one of Questor's strengths. There is more than one way to invest, and we believe readers will benefit from a variety of voices and approaches to choosing investments. So I'll now give you a quick idea of how I pick stocks. When I took on the job as a Questor writer, I asked myself this question: who knows a company best? My answer was the people who have committed large sums of money to a company's shares, either on their own behalf or more usually on behalf of clients. So I decided to base our Wednesday columns on interviews with fund managers about a stock in their portfolio that they were particularly enthusiastic about. The main advantage of this method in my eyes is that I can get the distilled case for owning a stock from someone who has researched the company in detail, often with the help of specialist analysts, and has very often known the business for some time, seen how it performs in different circumstances, and got to know the managers. Another advantage of this method is that I can cover stocks that I would never have come across on my own, especially the increasing number of overseas firms that Questor has tipped since the columns relaunched almost 5 years ago. A favourite example of mine is BioNTech, now famous as the developer of one of our life-saving COVID vaccines. I tipped it last August, before its vaccine was shown to be effective, on the strength of a discussion with a German-born fund manager who now runs a fund from Australia and happened to meet BioNTech's managers on a trip home. This fund manager is also a former virologist, so she could hardly have been better placed to evaluate the stock and explain its merits to us. I feel very fortunate to have the chance to call on the expertise of such fund managers, especially as BioNTech shares have gained 56% since our tip. That's enough for me for now. I will now introduce you to Russ Mould of the investment shop AJ Bell, who writes Questor on Tuesdays. Russ's experience makes him perhaps the perfect Questor writer. He has had a wide variety of roles in the city and come into contact with a huge number of company managers, analysts, investors, and investment styles. This all helps him to produce each week concise, no-nonsense analyses, spiced with some dry Yorkshire humour and the occasional reference to his other passion, horse racing. But now let me ask Russ to describe how he goes about choosing the stocks to feature in his Questor column. Over to you, Russ.
Thank you, Richard. I don't try and pick one particular type of stock because I know that Questor has a very broad readership who are looking for different things and have different investment styles and goals. So I do try and pick some stocks that you would call value, some that you would perhaps call income, and some that you would perhaps call momentum and growth. My own personal preference, having been as a fund manager, when I was a very young fund manager in the early 1990s, I was trained by a value house, and I was trained as a value manager during a bear market. So my natural inclination is to think about the downside first and valuation, and then think about where the upside may be. So I'm probably perhaps a bit more cautious than the average investor would be. What I then start looking for is a stock that's underperformed, that's underloved. Then I look at what could change that and what valuation upside there may be. I don't try and change the stocks that I talk about too much, because I'm aware of the fact that that can lead to fees, commissions, taxes, and they compound up just as much as dividends do. So I do try and be fairly cautious with those. And the things I try and avoid: weak balance sheets, bad governance, transformational acquisitions always make me my blood run cold. Regulatory change and structural change in industry.
Thank you, Russ.
Tripped me up in the past.
Now let me introduce the third of our writers, Dan Grote. Dan recently started to write the Thursday Questor column, which is our investment trust bargains format. But he is no newcomer to investment trusts. During a long career at Citywire, the specialist investment publisher, Dan became an expert in funds both open-ended and closed-ended, the latter, of course, being better known as investment trusts. He ran Citywire's Funds Insider website for many years, and more recently attracted widespread acclaim for a series of articles alerting readers to the problems with Neil Woodford's flagship fund before its suspension and the collapse of his business. He was the first journalist to uncover Woodford's listing of his unquoted investments in Guernsey to avoid breaching the city regulator's rules, a move the Financial Conduct Authority only discovered from Dan's story. He also revealed the huge scale of Hargreaves Lansdown's backing of Woodford for the first time. Dan, would you like to tell us about how you go about picking investment trusts for the column?
Sure. With investment trusts, the first thing that I'll look to is the track record of the fund manager. If they have a long track record and a successful track record, particularly in moments of stock market crises like we had last March, and particularly where, if those trusts are positioned as a defensive investment trust, I'd want to see evidence that they've been able to deliver on that pledge. The problem with that approach with the trust bargains column is that those successful trusts with very good long-term track records, their shares tend to be rated quite highly, and so they don't present the sort of bargains that we're looking for with the column. And generally, not in all cases, but generally we'll be looking to tip the shares of investment trusts that are trading at a relatively substantial discount to the value of its assets. But it's not just a question of trying to find the cheapest investment trusts with the biggest discounts. Some trusts will have big discounts to their assets for a very good reason and will have suffered that discount for a number of years. So really I'm looking for an investment trust trading at a discount to its shares that may be anomalous, that hasn't existed before, and where I think it's unmerited, where the trust has a good record, where the shares deserve a better rating, and where I can see the potential or a catalyst for that discount to close. Back to you, Richard.
Now it's time to open things up to you, our readers and listeners this morning. But let me quickly say here how much we welcome your feedback, not just now, but via your emails and comments on our WhatsApp group. If you've not come across the latter, just Google Questor WhatsApp or follow the link that should appear on your screen. In essence, it offers a summary of each day's Questor delivered via WhatsApp each morning, plus a very short podcast from one of us 3 times a week, normally delivered in the afternoon. So please now feel free to send us your questions. Please do ask us more about how we research and write our columns, or about picking shares and investment trusts in general. Please note, however, that by law we cannot give individual investment advice. Instead, everything we say is addressed to the audience as a whole, as an indication of our general views on the subjects in question. Please consult a regulated financial advisor if you need individual advice tailored to your circumstances. As I said, we'll aim to answer some of the questions submitted to us over the past couple of weeks, and I'll start with one of them now. And this is a question that we had submitted to us a couple of weeks ago. I don't have the name of the person who submitted it, I'm afraid, but it asks us for a nice general question about the state of stock markets to kick things off, asking each of us for our views on the British stock market versus the American one and the rest of the world. I'm going to ask Russ Mould to get it. We'll all have a say on this, but I'm going to ask Russ to start. Russ.
Okay, so so Yorkshireman, therefore naturally contrarian, one could argue. Admittedly, I've been thinking that the UK is due to finally put on some performance for a while, but I would certainly be, probably from a valuation perspective and a contrarian perspective, be more inclined to look at the UK than the US right now for all of the US strengths. The UK is trading pretty much in line with its long-term valuation on an earnings basis, whereas the US is trading well above. And the UK offers that 3.9% forecast dividend yield, which again is pretty respectable. And if that's your thing, and in some cases I approve them and in some cases less so, share buyback activity is picking up. So again, if you're looking for cash returns, the UK is starting to pick up speed here. In the end, the UK has underperformed hugely over the last 4 or 5 years, and underperformance can mean unloved, and unloved can mean undervalued. And I think I'm intrigued by the fact that we have seen several bids coming from overseas. The pound is still below where it was trading before the Brexit vote nearly 5 years ago. So I think you've got an equity market that doesn't look bad value, a currency that's potentially cheap. What you do need really though for the UK to pick up, I think, is a decent economic upturn, because it's packed with oils, miners and banks, all of whom are pretty economically sensitive. So if you're of the view that we're going to double dip or that the virus is going to stick around for a lot longer than we hope, the UK might not be the place for you. If you think that there is going to be good news on the virus and that economic activity will improve, then the UK actually has got a pretty interesting earnings
Thank you, Russ,
for that particular scenario.
Dan, do you want to pitch in on this one?
Yeah, I mean, I guess I'd echo Russ, and with the, with the difference between the UK and the US stock market, I guess it's a similar question to whether you would favour value or growth stocks. The US market has been driven higher by mega cap tech names, Facebook, Netflix, those sorts of businesses, while the UK stock market has a much larger contingent of value stocks, oil miners, banks, those sorts of companies. And with the rise in sort of inflationary fears that we've seen at the beginning of this year, you can see how that's been reflected in the performance of investment trusts. Certainly, a lot of the trusts run by Baillie Gifford, the Edinburgh Fund Group, that's very concentrated on growth companies, they've sold off, and those trusts investing in British value stocks like Temple Bar or Fidelity Special Values, they rallied. Without coming down firmly on either side, I guess what I would say is that for many investors, particularly investment trust investors, they may find that at this stage, with the fantastic run for US and for growth stocks certainly over the last year and over the last sort of 5 or 6, that those positions may now be occupying quite a large portion of their portfolio. So if there's any sort of fears around US and growth stocks becoming a bit more expensive, now might be the time to take just a few of the chips off the table and install some balance into portfolios that may have got a little bit out of kilter.
Thank you, Dan.
Year or so.
I'm just going to add perhaps a more a point of view that's less dependent on what's going on right now, to complement what the other two have said, and that's to make the point that America has until now been the driver of technological change, and so much more so than Europe and Britain, unfortunately, and that's reflected in its stock markets. So it is a different stock market. It does have it is so dominated by the companies that are behind the transformation that the economy has seen and will probably continue to see for quite a while. So if you want exposure to that kind of company, I'm afraid America is still the place to be, and some of this is reflected in some of the reason for the valuation being different. And I would say you need exposure to both. You need some exposure to those incredible companies that are continuously coming out of America, but you also need that sort of a bit of a bedrock in more solid, well-established companies, and perhaps you find more of those over here on this side of the Atlantic. I'm now going to ask to address a question that's been given to us just now by a participant called David Hoare, who has asked whether now is a good time to invest in the AIM market, and whether we have any recommendations. So I'm going to start with that, but I'll bring in Russ into the discussion as well. AIM is a very interesting market in that. For anyone who doesn't know, by the way, it's Britain's stock market for smaller, more recently established companies. It's a way for them to raise money on the stock market without jumping through the hoops involved in a conventional listing. So it's a quicker, easier way to raise money for investors, less regulated, more risky. But over the past year or so, it's had a very good time. It's performed much better than the London stock market as a whole. And you could say very broadly that perhaps that is because it is a little bit like the American market. It has a lot of startups. It has a lot of tech companies, biotech, as well as some miners at sort of the other end of the spectrum. And I suspect those tech and biotech companies have allowed it to perform so well over lockdown when so many tech companies have had a good time, whether they're American or British. So is it a good time for AIM? I would say, very broadly speaking, yes. But on AIM, more than probably anywhere, you have to choose your stocks very carefully indeed. There is, frankly, a lot of stocks that shouldn't be invested in, I don't think, by our readers or, frankly, anyone. So you really have to do your homework if you want to choose AIM stocks on your own. Fortunately, if you don't fancy that, you can look to help from the Questor column. We, for some years now, have run a regular column on AIM stocks, which we aim particularly at readers who are looking to avoid inheritance tax, because that is one of the perks of many AIM shares, if not all. That column now runs every third Friday as a rule, and the next one is due to appear this Friday. So do have a look if you haven't come across it before. Russ, do you want to say something briefly on your view on AIM? Is it a good time for AIM?
Yeah. I mean, it's the AIM all shares doubled in the last year. The Russell Index, the American equivalent, I suppose, has done incredibly well. And I think small caps are, to a degree, risk on. They're seen as an asset class that will do well when bull markets are running. And generally, smaller companies, more exposed to one geography or product or service, perhaps to one or two executives, less mature, so that they're certainly high risk. They can be high reward and generally perform well when the economy is buzzing or when risk appetite is high. So at the moment, it feels like they could be an interesting place. What I would say is that AIM is about 4% of the UK total market capitalization. So if you as an investor are looking at your portfolio and you've got more than 4% of your portfolio in AIMs, of your equity allocation in AIM, for example, then you are taking above average levels of risk. Now, so long as you're comfortable with that, that's absolutely fine. But if you're a more conservative investor, then you either need to reassess that or at least look at the types of stocks that you've got. I mean, there are some big AIM companies valued at over £1 billion. ASOS, Boohoo, Fevertree, Burford. So there are some very big companies in there. But if you're fishing around in some of the tiddlers, some of the micro caps, then you maybe do need to be a little bit careful, because they will be exposed to the downside if there is any economic trouble ahead, or if the market's hit an air pocket. So you just need to make sure that you're calibrating the amount of risk with the amount of reward that you're looking for.
Dan, I'm going to ask you a question from a reader. This is one that was submitted before the event, so I don't know who it's from, I'm afraid. But this reader points out that as he writes, or as he or she writes, Monk's Investment Trust is standing at a small premium to its net asset value. And he says he has made a successful switch between Scottish Mortgage and Monk's. Now, I wonder, some participants in this event won't know about Monk's, although I suspect most people have heard of Scottish Mortgage. Would you like to comment on these two trusts, which of course are run by the same group? Tell us about their differences, and tell us about the opportunity that Monk's, the lesser known of the two, offers to people who up to now may have been invested in Scottish Mortgage, but perhaps have been a bit frightened by its very violent ups and downs over the past couple of weeks. What can Monk's offer that perhaps is more suited to our readers than Scottish Mortgage?
I think in a few words, it's less volatility. So yeah, as you say, Scottish Mortgage and Monk's, both run by Baillie Gifford, who are based in Edinburgh, and as an investment group, are very focused on growth opportunities, growth stocks. The Scottish Mortgage and Monk's are both within their global equity stable, so they're investing in stocks from all around the world. Where they differ is that Monk's has a broader portfolio. It has less concentrated positions. So if you looked at the top 10 positions for Monk's, I think the number one position is 2.7% of the portfolio. In Scottish Mortgage's case, it has much punchier, bigger positions for its kind of high conviction top stocks. And that's reflected in the extraordinary run of performance that Scottish Mortgage enjoyed last year, and in the fall in the share price over the last month or so, as if inflationary fears have hit the outlook for growth stocks. Monk's shares in Monk's are sort of off over the same sort of period, but not by the same degree.
If you want to know how much debt a company has, how do you go about doing that? And perhaps after that, I'll ask you a bit more about what we can glean from company accounts. But on the debt first, how can you do that?
So the first thing to do is go to the balance sheet in either the interim results or the full year results. And what you then do is you go to the liability side and you add up short-term debt plus long-term debt plus any pension liability.
Are these things all easy to find?
You then probably need to go, yes.
Okay.
They're all disclosed. They're all very clear lines in the balance sheet under short-term liabilities and long-term liabilities. It's easier now. Leases used to be hidden down the back. They were never on balance sheet. They were off balance sheet. Hard to believe as it may be. You may still need to go down to the small print at the back to look at contingent liabilities, which are things like delayed payment for acquisitions, for example. But generally, if you go to short-term debt plus long-term debt plus leases plus pension liability, and then subtract from the other half of the balance sheet cash, investable securities, assets for disposal, and pension surplus, you will then get to a sum number. If you end up with a positive number of debt minus cash, you have a net debt position. If you have a negative number, you have a net cash position. Now, the one thing that you then have to double check is you then need to go to the profit and loss account and just see whether the company paid interest or not during the year. Because there are lots of companies, and Carillion was one of them, that always said that it had a net cash balance sheet, but it managed to pay interest during the year. So what you've got to remember is that the balance sheet is just a snapshot. It is literally taken on one day, say 30th of June and 31st of December. So the company has got shareholders to keep happy, which is our dear listeners and readers, but it's also got its banks to keep happy and its bondholders to keep happy. So the finance director's job, one of them, his or her, is to make the balance sheet look as sweet as possible so that on that given day, there are no pressure on bond covenants, for example, and that lenders and bankers are still happy to keep on lending the money and don't feel a sudden urge to pull the rug or indeed stop offering further debt. So you will be getting a fairly fit, the best view that the finance director can give you legally and legitimately. But that's why certain companies have certain financial year ends, for example. Next is results are due out next week. Its year end is January. Why would it have a financial year end in December when all the Christmas money is going to be trickling in January, for example? So it's not doing anything wrong. It's just making sure that it's presenting things in an appropriate fashion for its business cycle. And house builders often our financial year ends in April and June because that's when the money starts coming in for new sales, for example. So the accounts are a great starting point, but they're not an ending point. You then need to just use a little bit of imagination and tie the balance sheet into the P&L and into the cash flow. But that's the crude mathematics of how to work out a net debt position. And in crude terms, yes, the less net debt there is, or the more net cash there is.
Staying with company accounts, Russ, because I know you spend a lot of your time and you've spent a lot of your life, I think, looking through them. What's the very first thing you look at, you turn to when you pick up a new set of reports and accounts? And what do you think, if there's one thing that you must look at, what would that be?
Well, I always go to balance sheet first, cash flow second, profit and loss account third, because it's pretty hard to fudge cash, and it's pretty easy, and it's pretty hard to fudge revenues, but it's actually deceptively easy to fudge profits if you really set your mind about it. So cash is pretty hard to fiddle, and cash is king. It's what pays all the bills. So balance sheet first, cash flow second, P&L third. If I'm then looking for a really quick litmus test to just see if they all add up together, one thing that a very good colleague of mine always told me to do when I was a young analyst, and it served me well, is you can allow the odd years flicker here and there, but over time, sales growth, operating profit growth, and cash flow from operations growth should be going in the same direction. Now, there will be differences in speed, but if you've got a company that's generating sales growth and profits growth, but no cash flow growth, there just might be something funny going on. There might not be, but it's generally a fair test. So if you look at sales growth in the profit and loss account, operating profit growth in the profit and loss account, and then go to the cash flow statement and look at cash flow from operations, they should be pointing in the same direction at the very least. And if they don't, then you probably need to mind your eye.
Dan. Yes, that's extremely interesting. There was that quick way that you could see there was something strange about Carillion, because it said it had cash, so it shouldn't have been. You wouldn't expect it to pay interest, but in fact, it was paying interest. Dan, we lost you, I'm afraid. Well, welcome back.
Sorry.
I think everyone's used to it this year. Now, did you want to resume talking about the Scottish mortgage? Sorry about that.
Yeah, I don't know at which point my connection was lost, but I guess the point I was coming to was that Monks is generally a slightly more conservative version of Scottish mortgage. Interestingly, both are in similar positions now, in that the long-term sort of managers of both are stepping back. Charles Plowden in the case of Monks, and as we learned last week, James Anderson in the case of Scottish Mortgage. In terms of the discount and premium sort of opportunity on the shares, then Scottish Mortgage is now sort of presenting the opportunity in that its shares are trading at a discount of around 5% at the moment to the trust assets. Their shares don't tend to trade at a discount because of that extremely good long-term track record that shareholders in the trust have enjoyed. And that's really just a reflection of these fears over the valuation of growth companies that have been ignited by worries over inflation. Monks still trading on a premium, I think around sort of 3%, which is generally what it's enjoyed since Charles Plowden took on the trust and really re-energized it, gave it more of a growth focus than it did have before. So if you're looking to sort of play premiums and discounts on shares, then being brave and buying Scottish Mortgage would probably be the
right
thing to do of the two.
Okay, thank you, Dan. Now we've had a couple of questions in about value investing, and this is one of those expressions that I think can confuse. It certainly confused me when I first heard it, and I find it one of those expressions that are used possibly more often than understood. So I want, before I come to the more specific of the two questions about value investing, I want to just explain to participants what it is. And I think, Russ, probably you're ideally equipped to help us with this. So could you say in very briefly what is value investing?
One second, and I will do profits, earnings, profits in years.
Thank you.
I'm just answering your question. Right, value investing. Value investing and growth investing are both about growth. Value investing, I would say, is about jam today, growth now. You have at the moment, for example, people are moving into value stocks, be they, what would you say, travel stocks, leisure stocks, for example, because their shares have done badly. Companies therefore look very cheap relative to, say, earnings over a normal cycle or a peak cycle profit, for example. And therefore the view is if the economy recovers very strongly, then value stocks or cyclical stocks will give you lots and lots of earnings growth now for a very, very low multiple. And you can look at them relative to sales, earnings, book value or asset value in some cases. And that's how you come to the conclusion that a stock may be cheap. And if you then get lots of jam today, lots of growth today, those shares could perform very, very strongly. Growth investing, so the thing that we've just been hearing about from Dan with Monk's Investment Trust and Scottish Mortgage Investment Trust, they're probably more focused on jam tomorrow. That doesn't mean that they don't care about what happens now, but they're looking at companies that are capable of providing secular growth. It almost doesn't matter what the underlying economy does. These have got business models that they offer products and services that people want and will continue to want and will be very happy to pay for. So these companies have often got pricing power as well. And that they can see companies doing that over 5, 10, 15, 20 years or more. So there's a much bigger element of jam tomorrow about them. So growth is probably jam tomorrow, value is probably cyclical.
Thank you, Russ.
Jam today is how I would broadly see it.
Never heard it explained in less technical terms. I certainly appreciate that. Can I look at the same subject from a slightly different point of view with you, Dan? We had a question, I think a pre-submitted one, asking about funds for people who want to adopt this value style. Now, of course, Questor is about funds only in respect of investment trusts. Questor doesn't cover conventional funds, only listed funds, which are investment trusts. So, among the investment trusts that you have researched recently, are there any value funds that have caught your eye?
Well, I think if you're looking for value-focused investment trusts, you'd be naturally drawn to trusts that are investing in the British stock market, and there are plenty that have that sort of approach. I'm thinking about Aberforth smaller companies, which we covered recently in Questor Trust Bargains, and the Aberforth split level dividend, the more income-focused version of the trust run by the same managers. Temple Bar is a good example of a very value-focused approach, having previously been run by Alistair Munday, who stepped down last year. And I'd say Fidelity Special Values is one that doesn't have the maybe not as focused a value sort of approach as maybe Temple Bar would have. Maybe has more ability to kind of perform as the stock market is veering between a kind of growth and value being in favour. But Manager Alec's right is certainly drawn to stocks that he believes are trading too
Right.
cheaply.
Okay, thank you for that, Dan. I'm going back through the questions that we had pre-submitted to us, and one leaps out as requiring the shortest possible answers for all three of us. A reader has asked, do any of you own any cryptocurrencies? So I will say straight away, I do not. Russ, do you own any cryptocurrencies?
No, but then I don't manage my own investments because I'm not allowed to. All of my money is run discretionary, so your readers don't think
Could
that
I
I'm
maybe
talking
ask
about
you a
something like
hypothetical
selective
question
and
and
I'm
say
being
that
a naughty person.
if you weren't constrained by that, would you be tempted by cryptocurrencies? Yeah. Okay. Dan, any crypto?
No, not my thing.
Absolutely not. No, none here either. Yeah, I'd echo Russ. It's difficult to know how you value them, and I'm just much more comfortable in holding investment trusts in run by managers that I understand and am comfortable with their investment approach. So no,
Okay.
I don't think we'll be buying any.
So
anytime soon.
I'll just expand a little bit on what I said. So I don't own any cryptocurrency and never have. In fact, a few years ago, I wrote a fairly sort of negative comment in the Telegraph about Bitcoin, essentially calling it certainly not a scam, but a bubble that was about to burst. Burst it did, but of course it's come back to life, and more so, and it's close to its record high. I think Bitcoin is, if I were to buy any crypto, it would certainly be Bitcoin. I think it is developing a position as a serious asset. And I think we're getting to the point where where ordinary investors, people who are ourselves and people who are taking part in this event, need to start thinking about it. And this is something that I do plan to write about in Questor before long. So please keep a lookout. It'll be in our column which addresses inflation, which appears every third Friday. I think the next one is due in 2 weeks' time. I'm going to stick with the subject of inflation now. I think we've had a total of, well, at least 4 questions about it, both pre-submitted and this morning. I know one pre-submitted one asked if the Bank of England was printing money to fund government spending and whether this risked provoking inflation. So I'm going to start with the subject, and I'll try and bring the others in if there's time. So is the Bank of England printing money and lending it to the government? Yes, it is. I think it's a truth that almost dare not speak its name. It's not really the sort of thing that's supposed to happen. This is the kind of thing that has led to inflation in the past. But before we panic too much, I think we should say that this has been something that has been going on for 10 years or more since the financial crisis. Everyone expected it the first time to provoke high inflation, and it didn't happen, and it still isn't happening. And this is again a subject we have addressed in our column devoted to inflation that appears on certain Fridays. So my feeling is that unless the government and the Bank of England between them change the way that the quantitative easing program is run, we don't have too much to fear from higher inflation produced by what the Bank of England does. We may have other reasons to fear inflation. Now, I think it is actually possible that the bank and the government do change the way that QE is done, perhaps by allowing the money that the Bank of England creates to enter the real economy in ways that it hasn't so far. QE so far has been more, has ended up more in the newly created money remaining within the financial system and boosting the value of assets rather than causing inflation in the shops. So if QE changes, that result can change. It's something we will keep a very close eye on for our wealth preserver column in Questor, which keeps a very close eye on inflation and aims to counter it. Russ, do you want to add anything on this question? I know it is very high on many readers' minds. Do we have anything to fear from inflation in your view? Inflation?
I think if it happens, then it will be a seismic change, because I've been in the market for 30 years and all I've seen is disinflation or low inflation. And therefore, everything that's worked in the last 30 years in my entire career have generally been long duration assets, things that again have long-term back-end weighted cash flows like tech stocks, like biotech stocks and growth stocks and bonds. And what's done badly has generally been things like raw materials, commodities, stuff, value, and cyclicals. So if you get, and history is no guarantee for the future, of course. If it were, as Warren Buffett said, then the librarians would be the richest and best investors in the world. But if history does repeat itself, then, and you go back to the 60s and 70s, then everything that's worked for the last 30 years wouldn't work, and everything that hasn't worked would. So you actually would then want to be in commodities, gold, precious metals, real stuff, pricing power, stocks, value, and you wouldn't want to be in bonds, tech, and so on. So if it happens, it would be a huge change, and that's why it's such an important debate. It's why markets are on a state of high alert for it, because central banks are clearly determined to take the risk that they'll let it out of the bottle to make sure that the economy can get through the current situation, and that is a risk that they feel they're prepared to take. So from an investment perspective, yeah, it would be a massive deal if it happens. Why could it be different now from 10 years ago? Well, QE kind of injected the money into the banks last time, not directly into the economy. This time, governments are giving people checks. They are giving people furlough money. They are putting money straight into people's pockets, and they're cutting out the banks as the transmission mechanism. So money is going much more directly into the economy. It's not just money supply that matters, it's velocity of money and how quickly it travels. So if people are sat on the cash, the bank is sat on the cash, or somebody sticks the cash under their mattress, it kind of doesn't matter how much is printed to a degree. But once that money starts circulating, that's when you can get very rapid price inflation. Now, clearly, Austrian economists will say that inflation is about money supply, and money supply is going through the roof. Should we'd all be concerned anyway? But if money velocity picks up, and when we're all allowed out the house, we can all go and start spending. Those of us who are lucky enough to be able to do so, that's when you could get some inflation.
What's your gut feeling? Do you think inflation is going to pick up from here?
I would personally be surprised if it didn't. I think central banks will move absolute heaven and earth to ensure that it does. So under those circumstances, looking at where money supply growth is right now, 20% in the US, teens in the UK, it's even, I think, in double digits in Japan. I think it would be surprising if
how high do you think it could go in
this
country?
Kind at some stage, yes.
How high do you think it could go, Russ, in this country?
Well, yeah, I mean, Yogi Berra, the American baseball player, once said that baseball is 90% mental and the other half is physical. And I think that inflation is the same. It's a state of mind. I think if people start seeing things going up in the shops, that's when they're going to start knocking on the boss's door asking for pay rises, and that's when you really will start to see inflation tick along. I think mathematically, just because of where oil got to a year ago, it'll probably get to 3 or 4%. It's when if it lingers above that, I think that's when people will start to get worried, and we won't find that out.
Thanks, Russ. You mentioned oil just then. I know we've had a couple of questions about it. Never easy to try and make predictions about what's going to happen in the decades ahead, but a lot of people want to know. I think a lot of people own oil stocks in one form or another. How do you see the future for the oil giants?
I suspect, like all of these major transitions, that they become a lot steeper than we think. So I think oil will probably, whether we like it or not, be around for longer than we think. just because managing the transition to alternatives is going to take a lot of money and a lot of investment and a lot of time. So I think there may be a longer tail than we perhaps assume. Looking at it from a stock market perspective, oil was really interesting, particularly last year, because Exxon went out of the Dow Jones and Tesla went into the S&P 500. Okay, and that in itself is interesting because sentiment was clearly very down on one and very up on the other. And oil as a global percentage of market cap hit a record low at 2 or 3%. And funny enough, it's rallied hugely since then because expectations were so low. Expectations are now much more nuanced. Oil stocks have rallied. The oil price has begun to sort of hit a bit of a flat spot. So they're probably less straightforward than they once were, but it just showed like anything else. You know, when sentiment is really, really down on something, it doesn't take too much surprise on the upside from a share price perspective. You know, the cave that we fear to enter holds the treasure that we seek. So it was a classic contrarian play. It's probably a bit more nuanced now, but my gut instinct is oil will be around for longer than we would expect. The danger of the oil stocks, just the danger from the oil companies is that they're clearly looking to reinvent themselves, and they're under such pressure to do so that they end up overpaying for the acquisitions or the investments that they make, and the return on capital there is not perhaps what you've become accustomed to. But I think in the short term, markets might be forgiving of that just because the direction of travel in the long run, there may be a reckoning.
Thank you, Russ. Dan, another one for you. Could you just explain what you see as the key advantages of investment trusts over conventional funds for readers of Questor?
Well, I think if you look at the, there are a few sort of examples where you have the same manager running a fund, an open-ended fund, and an investment trust investing in the same sorts of areas of the market in both. And invariably, it's the investment trust that over time has performed better. One of the main reasons for that is because trusts are able to gear or to borrow in order to enhance returns. That's not available to open-ended investment companies and unit trusts. And I think, because of the way that trusts are listed on the stock market, like companies, they have shares, and those shares can move in a way that sometimes doesn't correspond with what the assets within the trust are doing. Then you get these premiums to assets and discounts to assets. And one of the opportunities that you get with investment trusts that you don't get with open-ended funds is the opportunity for a bargain, where you do see the shares of a trust at an unmerited discount to its assets. And that's another way in which kind of returns can be enhanced if you get it right and buy into a trust at a time when those shares are on a discount and that discount begins to close. But really, over the long term, if you're looking at why one does better than the other, the ability to borrow in what's been, a prolonged bull market, that's what gives investment trusts the edge.
Right. Thank you, Dan. Ladies and gentlemen, I think we've come to the end of our session, I'm afraid. So I am going to thank Dan and Russ for their contribution this morning, which has been most welcome. And thank you at home also for watching and listening and for sending in your questions.